So here's the thing, man. So you can get in futures commodity, you can get short plays, long plays. But what I want us to understand is this, right? As long-term, as investors, right? As investors, our role is to identify great investments that can make us great returns over the long term. Right? That's our objective. That's our role as investors. Right? And that's what somebody say. So you got to be able to look long term. For me, long term investments give us the biggest leverage in this game. Right? So I don't know how to give you plays to make quick money. I can put you in position to understand how to make the greatest long-term plays you can make. You feel what I'm saying? Like, I don't know how to, like, if you're looking for quick money, Trap is not the person to teach you that. Right? I'm not the person to teach you how to make quick money in the market. I'm the person to teach you how to build wealth. You feel me? I'm the person to teach you, how to identify great investments, how to find an entry point in those investments, and then how to get out, how to, rinse and repeat. Sell high, keep some of the profit, let it run. Like, that's me. I don't have nothing against a trader, an option, or Forex, or crypto, or nothing. I'm going to only teach you how Trap does it. And it doesn't even have to be 10, 20 years. It's saying, let's make a great investment. Once it get up so many percent, let's now take some of those profits, put it in and feed another investment. Right? So, and people think, yo, you just long-term Trap. No, I give myself leverage. I want to teach you all how to give yourself leverage in this game. When you learn how to leverage the time, when you learn how to leverage that and put that in your favor, then you become a great investor. The minute you try to outbeat time, you lose this game. So ETFs are great tools for us to build this game. So what I love about ETFs is this. So let's say the ETF has Apple, Amazon, Microsoft, whatever. Inside of that ETF, you now own a portion of the ownership inside of that ETF. Inside of those ETFs, it's a numerous amount of companies, right? A numerous amount of companies. So what you want to do now is go inside of those ETFs. This is where the holdings part is important. See what all companies the ETF is holding. Now you understand what's going on. And one of the dope things about the ETFs is it's actively managed, right? Well, passively managed, you could say that, because active is in and out every day. It's passively managed. So passively managed means once a year, they'll look at the holdings and see who hasn't performed well. They'll take that company out and put another company in. Or what they'll do is, if they see which one ain't performing well, what they'll do is take money from that one and put it somewhere else. Or they'll take the percentage out of that and add it somewhere else. So you'll see the percentages of the ETFs shifting. Yes, you can own as many ETFs you want to do. So one of the things I want to do, again, I told you I'm going to give you actionable steps that you can take. Right? I'm going to give you actionable steps that you can take. I already gave you 5 ETFs. Another ETF I gave y'all that I can tell you about is SMHB. It's up 352% on the year. In 1 year, it's up 352%. Feel me? So I want to give you actionable steps. That's my thing, man. I'm always about giving people like actionable steps that they can take when I come on these lives. It's all about me just giving free game, right? And that's what I want. Like, if I'm gonna give you free game right here, imagine how we breaking down game inside of Trappers Anonymous. You know what I'm saying? Like, we go crazy in there. So let's talk about like why ETFs are dope. So everybody who knows me knows that I'm not a fan of dollar cost averaging. Well, Trap, why are you not a fan of dollar cost averaging? So let's look at this idea. All right, so this is why I don't like dollar cost averaging. So let's bring this down to year to date. All right, so this is what I want to tell you. This is from April 2020, right? So if you were dollar cost averaging, that means every month you will buy into this stock, right? Every month you will buy into this stock, right? So if you were dollar cost averaging, if you bought in April, you bought it at $24. And then you bought in May, you bought it at $28. And then you bought it in June. So let's say you bought 10 shares in April at $24. If you bought in May, you bought another 10 shares at $28. If you bought in June, you bought another 10 shares at $33. If you bought in July, you bought another 10 shares at $36. If you bought in August, you bought another 10 shares at $45. If you bought in September, you bought another 10 shares at $57. If you bought in October, you bought another 10 shares at $63. If you bought in November, you bought another 10 shares at $70. If you bought in December, you bought another 10 shares at $82. Then if you bought in January, you bought another 10 shares at $102. And then you bought in February, you bought another 10 shares at $112. And then if you bought in March, you bought another, you finally got a little break because you bought another 10 shares at $102. Does anybody understand why I don't like dollar cost averaging? With individual stocks, if you dollar cost average over time, you're actually buying the stock. You overpaying for it. You're overpaying for it. So in that 1 year, you bought, every time you purchased it, you bought it an extra $10, $20 more. You losing leverage. Now, I will say this. With ETFs, I don't mind you dollar cost averaging. With ETFs, I don't mind you dollar cost averaging. Because you essentially you set a number, I want to own this many shares. You dollar cost average until you get that many shares, and then you leave it alone and you let it run. Because the ETF most likely is going to perform anyway. When it comes to regular stocks or individual stocks, when you dollar cost average, you're now defeating the purpose of getting the gains. Investing is a game of returns. You get great returns by buying stocks at discounted prices. With ETFs or index funds or even REITs maybe, I don't mind you dollar cost averaging because those are more so safe plays and cash cows. Right? Safe plays and cash cows. With individual stocks, I will not amen that, but that's just me. Some investors are cool with that because they want, for me, I'm like, nah, I'm cool. It's not even, and so that's why people get lost too when they say buy the dip. That's not a strategy, right? Buying the dip isn't a strategy. Let's go back to the board. Let's go to Amazon. Let me just think off the top of my head, y'all. Right? So let's say we're looking at a 1 year strategy. A 1 year, Amazon was, let's open it up a little bit. All right, so let's say we got here, Amazon was 1771. Amazon was 1771, right? So it went up a little bit, then it got right here. It went to 18. Essentially, it went to 1763. That's a dip. Do you buy it? Do you buy it? And then, so essentially, if you bought it at 1771, it has dips a few times. You wouldn't necessarily buy it again. To me, none of this is a sale. None of this is, if I bought it at 1771 and it goes here at 1755, that's not a sale for me. I wouldn't buy it at that because I spent $1,700 on it. Right? So now, check this out. So you bought it at 1771. You bought it at 1771, and then now it's at let's say we get to this price right here and it's at 34.85. Here's a dip. The dip right here is at 29.06. Do you buy more here? Do you buy more at 29.06? I wouldn't, because I bought it at 17. I bought it at 17.71. Why would I buy it again at 2,900? Here's another dip. It dipped right here. You bought it at 17. It ran all the way up to 30 something, 31, and then it dipped again at 3,000. Do you buy that dip too? Because here's what I did. I bought it at 19, and then it went down to 13 when I got it. But it took me a year to get it. But I got it at 13. So my cost basis went from 19 to 1653. That whole idea and terminology of just buy the dip, no. You need to understand how much the stock is worth first before you just so-called buy the dip. I bought Amazon at 17, at 1,800. I haven't touched it again. I haven't touched it again. Now what I'm going to do is I'm going to reevaluate the business. Once I reevaluate the business, I'm going to say, okay, what is it? I reevaluate a business once every 6 months or once a year. You feel me? Because now once you reevaluate and you understand what it's worth, now you know what you're willing to pay for it. So that it makes me cringe when people say buy the dip. No, I'm not buying a dip. I need to buy it when it's on sale or at fair price. Because I remember when Chipotle went to 1,100 and I missed it at 2. I missed it when it was at 300. I waited 2 years and I was able to get it at 400. I waited 2 years and I was able to get it at 400, 425. I missed it at 280, 380. I missed it at 380 in 2018. Go check the books. 2018, it was at 380. I missed it. I waited 2 years. It ran up to $1,100. I could have been like, man, I'm going to just buy, man. I'm going to just buy. Because it ain't never going to go back down to 300 or 400 again. And then what happened? 2020 happened. It went down to 425. I didn't miss 2 years worth of gain. You know why I didn't miss 2 years worth of gains? Because I had other stocks working for me. That's the problem with a lot of people that invest in, right? So it went from 300 to $1,000. And I'm not mad at you for doing that. But you know what has made Warren Buffett, Peter Lynch, you know what made them people the best investors and have the greatest returns of all time? They understood what the company was worth and they wasn't willing to pay $1 more than that for it. And if the greats did that, I'm gonna use that because they became super successful at that. Right? They became super successful at that. They became the greatest investors of all time by saying, I understand what this company is worth and I'm not willing to pay more than that for it. And if that's what worked for them, I'm cool with that. I'm not okay with buying nothing overpriced. Investment is about a game of returns. So let's say you bought it at 300, you got it at 380, it went up to 900. All right, cool. I'm cool with that. That's why my screen is red today. I'm okay. Don't bother me. I'm okay with that, fam. I'm okay with having a red screen. I have green screens a lot. And who says my screen is red today? You saw my screen? That's the problem, man. Like, I just want to give game. Yo, I ain't in here to get in no pissing contest with y'all, man. Like, anybody who want to help and want to be helped, man, I'm cool with helping y'all. Anybody else, man, I'm good. Y'all can keep rambling, man. You know what I'm saying? So the objective is, in order to average down, like, I'm not a fan of anybody, like with individual stocks. If that works for you, like if you want to dollar cost average with individual stocks, that's cool. For me, I'm alright with saying, once I find out what this stock is worth, I'm a lock in on it. You know what I'm saying? And so what I want people to understand too, let's get back to these ETFs. And I just want to show y'all, like, when it comes to ETFs, I don't mind you dollar cost averaging, because with the ETFs, what we doing is we getting you in the game and we giving you actionable plays that you can make. And because ETFs don't hold the same value as stocks, but you can still get great returns, you can still do that, right? So for somebody new, right? For somebody new who want to get in, who you haven't started, Like, let me show you how you can set your portfolio up in a certain way, right? So you can take 25% and put it in growth ETFs. You can take 25% and put it in dividend ETFs. And you can take 25% and put it in real estate ETFs. Now you've covered 3 sectors of the market. And then you can take the last 25% of your portfolio and put it in individual stocks. You can get you 3 to 5 individual stocks. So now what you're doing is the ETF is going to give you balance, growth, dividend, real estate ETFs, and then those individual stocks will fuel your returns. And then when the individual stocks may go down and take a dip, you're now still gaining leverage with your ETFs. So now if you're a new investor, you haven't started, that's a way for you to leverage your portfolio, right? And it's a great way for you to get in the game, and it's a great way for you to be active. How do you find real estate ETFs? One of the real estate ETFs I know is VNQ. It has 181 REITs in it. I think the average rate of return for VNQ is somewhere around 9.8 to 10% a year. That's not bad. It's an ETF, so that's in real estate, so it's not bad. And I think last year alone it returned 57%. So you probably can do that. You know what I'm saying? So you can definitely do that. So for you, before you could do 25% growth stocks, you could do 25% dividends, and you can do 25% real estate. And then you can now take the last 25% and use that for individual stock investing. And now what happens is, what you've now done is said, I've given myself balance, I've given myself comfort, I've took the risk away from myself. And then with the 3 to 5 regular stocks, individual stocks, you can use those as fuel to your return. So if your ETFs are doing great, you can use that last one as a fuel for that. You know what I'm saying? So that's definitely a way to do that, man. And I just want to come, and again, if you're a new investor, you want to just, you know what I'm saying, get in the game, you can use, like I said, 70% of your portfolio can be in ETFs, and use that other 25% to be in individual stocks, man.